You know, my laptop is going nuts today, and I know that I'm on a, like, it's all kind of like, y'all can't hear anything. What's up, everybody? Good morning. Good morning. All right, Zoom, I'm gonna need you guys to do me a favor, because right now everything's kind of on my, because I'm traveling for the next 2 days. I need everybody, yeah, everybody go to YouTube real quick, because right now, I don't know, I don't have time to reset my laptop, but my laptop's using 100% of the CPU here, and so it's gonna freeze up if I don't cancel Zoom. So everybody at Zoom, go to YouTube today, and we'll be back on Zoom at 3 o'clock in the afternoon, but let's all pile in. I took the delay off the stream. For some reason, my computer is hating me today. What's up? What's up, y'all? All right. Let me give you guys the link. All right, you guys go over there. Zoom. What's up, you guys? All right, that should be better. What's up, guys? Okay, wait, you guys can y'all hear music? Morning, good morning. Good morning, Christos. What's up? Diva, Simon, Diego, Icewild, SV, Gene, Christos, Ian, Lawrence, J Hex. You guys can hear me? Can hear music? No delay? Everything good? We good? Man, it's been, I can't even hear the music on my end. That's funny. Function. Oh, there we go. Is it too loud? Let's turn it down a little bit. All right, you guys, I am traveling, so I am in the middle of a, like, middle of Texas. I'll be here for the next, I'll be here till Thursday, actually. And Thursday, I won't be able to stream either. I'm gonna be back Friday for another giveaway at Elite Trader Funding. Yeah. Gotta love these. Gotta love these last minute trips here. It's supposed to be just for a day, but kind of things got postponed, and I was like, well, I can drive home and come back, or I can just stay there for a couple more days. It would be cheaper to stay, and then because we drove, so. But it got me, you know, I get a pretty gnarly travel setup, so you guys don't like it. I'll show some pictures in Discord. Those extended fold-out monitors. Let me tell you a trick. I do have some travel monitors. I have one that's really good. It's a travel touchscreen, but it's like a 15-inch, or it's the size of my laptop. My laptop's like the bigger screen. So I have like two side by side, but when I'm staying for like 3 or 4 days, I just go buy like a really big monitor. Like I bought a 32-inch curved screen, you know, and then you know, you can always take it back. You gotta love Best Buy. No questions asked. It's like the Nordstrom of electronics. Yeah, like Nordstrom has like the lifetime return policy. You buy a pair of shoes and 10 years later, just take it back, get your money. It's true. It's a true story. Yeah. So I'll get a monitor and I don't take any of the plastic off of it. I leave it there and then I just use it because sometimes when I'm here for extended periods of time, I can't stare at that little 15-inch screen. And I'm going to be here for 3 days working. So I was like, well, I need a bigger monitor. Actually, I'm debating on keeping this one because this monitor is so badass. And I did drive so I can take it home. But I don't know where I would put it at home. Because all my monitors are 27-inch. I have 6 27 inches at home. So I'm like, I always wanted to try a curved screen too. So I'm like, oh, I actually keep this one. All right. Full in the middle DD bands. Yesterday, I think we had a DD band touch at the bottom. Interesting setups. Okay, so futures here, kind of riding the middle DD. Futures here, riding middle DD. That's great. You had some selling pressure yesterday. It looks like QQQ tried to break monthly hedge, which is not the most usual thing to happen. But of course, you know, some of our things happen. You have the stats, you know, things 100%. So S&P broke bull zone a few times. It shouldn't do that, right? As much as it does. Sorry. It should hold much more than it doesn't hold. So this is one of the days it didn't hold. So open, blue open. Blue open is the BLU setup. There were 2 of those that worked out pretty well. Let me my pencil here. You guys know me. DD band's always a long entry point attempt for me. Yes, I will always attempt to long DD bands. Where's my pencil? Pencil tool. You see it on my screen? Hold on 1 second. You can't play without the pencil. 2 here. I'll hit it one more time there. If it pulls through. Or actually, that's only... No, I'll probably just hang on to this one. Well, there we go. Come on, baby. Open blue open. Let's tap it. Let's go. Resilience is negative on NASDAQ, though, so bring some resistance here. Just like yesterday's setup, probably going to try to happen again. So I don't think I'm going to hold this one for the big blast out, but at least if we return to open, I might hang on to that one for that. Oops. I mean, I'll take it. Take the profit on that one. Big candle like that, never trust it. Never trust it. Let's let it bounce around a little bit more. All right, took the profit $700. That's in the funded account. Let's go. Maybe I can do this all day long, guys. I mean, let's just be real here. Number 1 for a reason, you guys. I mean, come on. Can I enlarge a little bit like before? That's what she said. Well, you like it like that? Is that how you like it, baby? Is that better, Brian? Slightly bigger? What is that here? Brian, you want a little bit bigger? Is that okay? But save the porno voice, please. So what's crazy with this monitor is this is the biggest monitor I've ever used in my life. This thing is a freaking monster. So on my screen, these candles are like 3 inches tall. That's how big this screen is. Big monitor, big trade. Oh, baby likes them big. It's like, give me more. All right. So the reason I cut early because anytime you get a candle that just moves straight up to return to open, I usually cut. Resiliences are positive, so this is good. So now going forward, I just pocketed that $800 super quick. Normally what happens is when you get a big green candle like that, I usually, and just as like a quick algorithmic retrace, I don't usually trust that as trending, but it looks like it is starting to trend. So now going forward, any support right here at open is a run to DVAN today. So this was open, blue open, trade 1A on liquidity map. This was so freaking easy. All right. And just to let you guys know, some people are asking about the giveaway. So because I've been out of town and because it's been kind of like crazy over here, we'll extend the giveaway entry for like one more day. I said I was gonna do it on the 10th, but I had to bail, and so now we're gonna do it on this Friday. We'll make this Friday all the big giveaways. So if you wanted to enter the giveaway for 2 lifetime memberships, which is free access to the platform, Zoom calls, training, all the indicators, all the tools, everything we make in the future, all that stuff for free for life, where the majority of our 6,000 members are lifetime members, by the way. It's $4,000. You get it for free if your name gets in the drawing. And all you have to do is sign up for our monthly membership for 1 month to enter the drawing. There's only been 30 people to sign up when we're giving away 2 of them. So your chances are really good to do that. So check it out. Sign up for a month. And then we'll do the giveaway when I get back to town on Friday. So let me give you guys a link for that. Again, we train you on all these different things. And if you like what you see, we teach you how to beat these trader funding programs. That's what we do. Ice pocket $800 in the funded account. Let's go. I know it's going to be super unsexy if nothing else again happens for the rest of the day. But we shall see. So check us out if you guys are here. We do special training on trader fundings, eval, drawdown management, everything here. Okay, so open blue open is a 1B trade. 1B, oops, I think I said 1A yesterday. 1B setup, open, blue, open, high probability setup. It is this little guy right here. Then any support going forward is a 1A trade at DD-band. This is looking really strong today on QQQ. Let's double check SPY, because SPY open mean reversion. SPY getting that love. Yeah, so the thing is that inside of here, while QQQ is looking very, very pretty for a big setup, this is my least favorite trade, is to break the bull zone. The question you always have here is, do you take this to DD-band? Good R&R on this trade. So technically, it's a decent setup. Let's run the numbers real quick. But do I want to risk losing the money I already made? We are right in the middle. So here to there is about 30 points of run. About a 10 point of stop is a 3-to-1 trade. If it does work out, we'll see. How long does it take for data to refresh after you upgrade the live? It should be instant. So as soon as you pay for your live data, it should work. If it hasn't worked, double check that you paid for it on your dashboard. Sometimes you get to the end, but you didn't pay for it or you didn't fully register. So after you sign up for it, you have to fill out your exchange agreement. So if you didn't do all of the steps, it won't give you your data. So go to your dashboard, make sure that's done. You know, when you guys sign up for like your brokers, Thinkorswim and all that, you always have to go e-sign all those documents. You gotta do the same thing here to make sure that's done. Where am I? I'm in Dallas. Yeah, actually I'm in the boonies of Dallas on the north side. It's quiet up here. It's actually kind of nice. Quiet. We're gonna be here for, let's see. I'll be here till I'll be coming home Thursday. LFG, Ice Wild. Oh, it means let's fucking go. Gamer thing. Or I guess a trader thing too. Or I guess if you're a gamer looking for group, all you old Warcraft players in here might know that. Yeah, it's looking for group. Yeah. Okay, so somebody plays MMOs. Level 55 Rep Pally looking for group. Ping me. Looking for group, Lich King. Dude, half the people in here are nerds, dude. Listen, all these numbskulls in this chat are all gamers and nerds. That's what we do when we grow up, become traders. I'm not gonna lie, dude. As a Frost Mage, Strat Horse Run. Oh my god. I remember those. I fucking grind the shovel for like ever and ever and ever. Yeah, well, I used to play a lot of games. I was an MMO gamer back in the day. The problem with this break, mean reversion doesn't break the bull zone and go too often. We always say it likes to close in the middle, so we're watching to see the deterioration. Spy is actually, resiliences are looking good enough for it to hold. So the correct trade from here is, along with the small setup to go to DD band, is the actual correct trade from here with like micros maybe. But the stronger setup is to wait for the pullback, like bull zone. You're a gnome frost mage. I expanded it, but essentially this is only 10 points in the S&P. Long, big. Call it like normal. Long again. So here and here, anywhere inside of here is a trade to move up if you're looking on the breakout. Wait, somebody asked me the funded account. Which funded account are you talking about? Your account? I haven't told you guys the size of my funded account. Remember, I can't tell you guys the size, unfortunately. So small, long again with the stop just underneath here. Because remember, I take this trade every single time, and so this would be to DD only if like for a swing to DD all the way. Because it opens in mean reversion and it wants to be in mean reversion. See over here to the side, it opens here. Very rarely does it break out and go. And with yesterday's selling, I'm still a little timid on the market. I'd more like to wait for here. Could miss out on a 30-point rip, but you know, to see that the S&P is really fighting, it's trying to go positive, but it's having a hard time doing so. I think I'm gonna let it pull back. So I'm not taking the smalling. Usually I don't. You guys, if y'all watch me trade, while this is an appropriate trade because the R&R is really good, the most correct trade is this one here. So I always say the pullback one's the stronger one, but there's on the bull zone. Today is the calculation to get the size of your account. Oh, the position size. Okay. So basically what you do is you take the net lick of the account divided by the 1.1 times the maintenance requirement. Okay, let me teach you how to do this. So if you're doing eval accounts, the 100K is not your guideline. Let me teach you something really quick. Here's a trick. Let me go to see me group. Futures traders out there, do you guys want to know a trick to position sizing? So that you don't blow up your accounts by oversizing. You can blow up your account by being dumb, but at least you're not betting too big. Let me teach you how to bet correctly. Size-wise, there's a trick. There's a great equation you can use. If you guys use this, you're gonna thank me for this later, okay? CME margins, performance bond margins. Just rewind this part of the stream and go back and watch it. Okay. Go here. They've changed the layout. What the heck is it? Margin requirements. All right, cool. Click span. Span 1, not span 2. Go here, pick your exchange. You guys are trading NASDAQ and S&P. CME group, equity index. Again, just do this. I promise you guys will. You guys thank me later. Let's do the S&P first. 14,600. Okay, write this number down. Okay. All right. Multiply that times 1.1. Okay. That's 0.6061. I was state middle math champion when I was a kid. Look at that. All right, let's go. So you take this number, plug into here. So if you have a $100,000 account, then you divide 100,000 by 16, which is roughly 6.5. So you never trade more than 6.5 minis. Now, however, in these funded accounts, you might say, oh, you have 100K with drawdown of 3,000. Okay, an example. When you have a funded program account, an eval account, or even a sim to funded account, the net lick in a normal futures account is the amount of money you're trading with, your actual account. Never, if you use this equation, you will basically like demargin the position. You'll be trading appropriately to the size. An example, let me show you really quick some cool examples with this. Now here, just know FYI, if you guys are just watching for my trade, I'm waiting for this right here, the long setup here. Okay, I'm not going to take this 3-to-1 trade here. I'm going to let it go. So if you have like a 100K drawdown account with $3,000 trailing drawdown, then your account size is actually this. Don't let the numbers that are big fool you. If you have a 100K static account with ETF with a drawdown of $625, because that's what it is, ladies and gentlemen, your account is $625. Everyone, and type yes in chat if you understand the philosophy, or say no if you don't understand this. Your drawdown, your daily loss limit, or your static drawdown, whatever the lesser of those three is your actual account size. So that's the number that goes into here. And trust me, when I say you have a $625 account, you will be trading a micro or two to get out the door. This equation is really, 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 really good. So again, the CME group gives you margin requirements, and margin requirements are how we calculate our DD bands. The margin requirements are beautiful numbers because they pack so much information to them. That's the daily expected range futures are expected to take when the markets are closed. Or essentially span calculates ranges, margin requirements based on ranges of risk. The market makers are mostly shorting from there and longing from there against periodic longing and shorting, taking the other side of the trade. They report their positions, and the CME group takes this, plugs it into span, and then out of span, they look at these risk ranges, and then they get these margin requirements. So we figured out a way to take those margin requirements and reverse engineer the ranges. It gives us the risk interval, the DD bands, and all this other stuff. I also use the margin requirement to calculate your max position size. If you didn't think you can do that, you guys are watching the best futures trading stream on fucking planet Earth, because these are things that nobody teaches you. Margin requirements go up when the expected range of volatility is expected to go up. Margin requirements go down when the range goes down. So the volatility is proportional to the amount of drawdown you take. So therefore, we use that expected range to thaw our position. Bigger the volatility, smaller the position. So you basically coast within the expected range if you use this equation. Divide your net lick by the margin requirement, or the maintenance requirement, times 1.1. CME margins will report this right here. Just go to CME margins, walk through the steps, rewind to that part of the stream. They give this thing called maintenance, multiply it by 1.1. Long story why that is, but that's what you do. Get this number, divide them up. If you have a $3,000 drawdown with a $2,000 daily loss limit, then your account is $2,000, not $3,000. It's the lesser of the two. Whatever criteria, I call them bust criteria. So when you have funded accounts, they come in like 3 different flavors, okay? 3 or 4 different flavors. And when you really want to put them all side by side, we call them your bust criteria. What makes you go bust? Some of them have a static, which is just here's where you are. You pass this limit, you're done. Some of them have a trailing drawdown, which means a certain amount off of the high of the account, you're done. Some of them have a daily loss limit, meaning no matter what your drawdown is, if you lose X amount for the day, you're done. And then ETF is cool because they have an end of the day drawdown, which basically trails your account, but is only marked the account value at the end of the day. So basically your bust criteria are one of these 4, and they're all the funded programs are the same. Some accounts will have multiple bust criteria in the same account. For example, your run-of-the-mill ETF fast tracks are going to have a trailing drawdown, or your end of the day is going to have a daily loss limit and an end of the day drawdown. So if you have 2 bust criteria in the same account, it's the lesser of the 2 becomes your account size. Basically, however far you are from right now to blowing up, that's the number that goes in here. And here's how awesome that number actually is. You guys have to trust me on this if you haven't gone through our courses to understand. DD bands are magical numbers. Okay, they're based on the risk interval. I think yesterday you guys witnessed NASDAQ tap the lower DD band. There's something magical about this distance. There's a lot of math that goes into it, but you may notice that when the market falls to here, very often you get that support to come back in, and vice versa. 88% of days will close inside of these green bands. As a matter of fact, half of the distance of this band is what I call the burp distance when the market's running along and CPI comes out and the market just jumps really quick before it moves. That jump really quick, i.e. the market burps, is typically this distance as well. It's all baked into that margin requirement. It's the expected range futures can move while the equities market is closed. And when the futures market burps in that split second before the equities market can catch up, it usually burps that same distance. Like I said, risk interval is the underlying matrix of the futures market. And when you learn that from us, that's why everybody, if you read the reviews about our course, to say it's mind-blowing. We show you this stuff, and then you come here, and then you watch market hit here, and then somehow reverse with like massive volume at that green line. You realize we're onto something. So all of that's baked into your position size. Long story short, let me show you something pretty cool. So we know the market tends to like stay within those lines 88% of days, right? S&P right here is 40 points. Now let me do some math with you, okay? 40 points. Let's keep that in the back of our mind. But saying that you were long the market and all of a sudden, you know, Donald Trump tweets something, you know, remember when he was president, his tweets would make the market go all over the place, right? So say he tweets something, all of a sudden the market falls 40 points just on a whim. He says, we're going to, you know, tariff China or something. Market drops 40 points. Here's what 40 points looks like if you use this equation. On a 100K basis, remember, markets just kind of like, you know, mosey on around, and on the biggest snap finger move, it will move this risk interval. So you basically can tell yourself that the risk interval is the amount in which the market will move against you on a finger snap. Very rarely you're going to see the market drop 80, 90, 100 points without you knowing something's coming along. Even adverse news like, hey, Powell and his friends were talking, they're thinking about raising interest rates. The market would immediately dip 40 points. Before it kept going. But at least you get a stopping point for you to reassess your life at that point. Okay, so on a 100K basis right here, and if the margin requirement for S&P was 14.6 times 1.1 is 16,600. If you divide that by 100K, That's roughly like, what, 6.5, right? So this is your initial margin requirement. This is your net lick. Oops. Let me show you what that looks like on your account. This is how you position size. $40 points of move. Every 10 points in the S&P is $500, right? Per contract. So every 40 points is 2,000 per contract. And if you were to multiply 6.5 times 2,000, it's roughly $13,000 of loss. And that may seem like a lot if this was your max position size, but look at this. It's on a 100K basis, it's roughly 13% of your account on the, 1 out of 30 days, the market just burps the other direction when you're not paying attention. So when you use this equation, you basically limit your worst case loss of you sleeping at the wheel, not paying attention, to being about 13% of your account. The market will blip and usually reverse, or blip and usually hold. You get plenty of time to wait for that. The last thing you want to do is for the market to blip and you've lost all your money. So this equation limits you to roughly 10 to 14% worst case loss. The market burps against you. Now, under normal circumstances, had you just long the market and you bag held all day and it hit the DD band, and 88% of days it comes back in, at maximum, your drawdown was that much as well. So you're never going to blow up your account 88% of days. And then those 1 out of every 2 months finger snap goes away. At maximum, it's that much if you use this equation. And it's always that much because it scales with the risk interval, with the margin requirements. So remember, net lick divided by 1.1 times the maintenance limits your pretty much your loss to 0% to 13% ish range. So basically, you're not losing more than 10 to 13% of your trading account on the worst case days. So if you're trading with like funded accounts with $2,000 of drawdown, and you want to know the correct position size, what was that, 16,000 something? Okay. So there's a period right here. You're obviously trading micros, right? Is that 13? Hold on. Let me double check what was the margin requirement? Was it 16,000? You're trading micros. 0.125. Yeah, you're trading a micro, maybe two. Believe it or not. 125. Yeah. 125. So here, that's of a mini. You're literally trading a micro. Don't watch the kids on YouTube that are going in there. I'm gonna warn you against this. Your prop firm salesmen, the ones that drive fancy cars and this and that, they get paid hundreds of thousands of dollars a month in salary. I said a month, to promote these programs. And what they get told to do is they literally get told to trade 20 accounts and then tether them together at, look at this. I made $1,000 times 20. That's $2,000. They get paid to do that. That's the marketing strategy. We'll give you $200,000 a month if you just go trade 20 accounts on your stream. It's not the smart thing to do. And they might spend $50,000 a month to continue trading as they blow up all the time. But that gets you to buy 20 accounts. It's a marketing trick. It's not the smartest way to approach trader funding programs, by all means. You shouldn't go in there and just keep rolling the dice every single day, trading 3 or 4 micros with 3 or 4 minis with $2,000 drawdown. Don't do that. People are getting paid to teach you to do that, so you could buy 20 accounts. Now, however, when they have a sale and the accounts are 90% off or 80% off, then go do that. I do that. When the accounts are dirt cheap, I stock up on 20 of them and I pass them all at 20 bucks a pop. No, that was like 0.12. That's 1 micro, by the way. That's again in the worst case scenario, so that you know that every time you double that, remember, that's not what you have to do. But if you're only battling $2,000 a drawdown, 1.2 micros on the worst case days that you just bag hold with no response. Now again, you're gonna trade it. This is the maximum that you'll utilize on a day where the market's gonna fly against you. You're just using this as a gauge, so that's gonna be roughly. I'm just gonna round it to 12%. 2 micros will be 24%. 4 micros will be 48%. So again, if the accounts are dirt cheap, you don't care about blowing them up because you're just stocking up on the evals, then hit them hard. But if it's like the account that matters, like you're actually in your funded account and you want to gracefully move off the line, use this. You will lose half of your account with 4 micros. Just think of it like that. So you can decide what your appetite for risk is, but if you've got a $2,000 drawdown, 4 micros from here to here is half of your account. But you're never going to really hold upside down, you know, for 40 points. We were going to train you that you're never going to go more than 10 points S&P, 40 points NASDAQ. So it should be much less than that if you're disciplined. But know that when you're trading, you have to be watching, because volatile presidents, they use Twitter a lot, have created 40-point dips in the market. So make sure that if you're longing all 20 of your accounts at once, a snap of a finger can kick them all out. It's very rare that that happens. So you may decide that that risk isn't, you don't need to be so light on your risk. You don't have to be so stringent on your risk. But if you're trading into an event, CPI, any of that stuff, or volatile markets, use this as a guide. Normally, nice trickling markets almost all the time. You don't have to be so strict. You can use this gauge to know how much you're going to lose at the maximum. And if I'm going to lose 10 points per micro or per mini, that's only 500 bucks per mini, which is still a quarter of your account on a 10-point stop loss. So the maximum stop loss that we train here is 10 points S&P, 40 points NASDAQ, and no more than that. But you may not have control of that if the market just dips really quick. Your market order gets filled way below your stop. So you have to choose which environment you're in. If there's a possible finger snap, use this. If the market's trickling along, use this. And again, decide how much you're willing to lose per day. On a $2,000 account, I like to use the 25% rule. I don't lose more than a quarter of my account per day on the non-finger snap day. So no news, just trickle day. Mechanics look good. I will play, I will lose at most $500, which is a quarter. For on a 10-point stop is exactly 1 mini per $2,000. That's the rule of thumb I like to use. So 1 mini for every 2,000 in net lick. Limits my 10-point stop. Is 500 bucks, which is a quarter of my account, right? And that's what I usually use. On my statics, to get the statics off the door, out the ground, statics, I use the other equation. On a 100K static, you will see me trading 2 micros, 1 to 2 micros on that thing to get it out the door. So I promise you guys, if you use position sizing guidelines like this, you have a much more fun. Oh, baby. All right, let's hit that MHP. Let's go on S&P. Let's tap her. Bears on top and coming. Let's go. S&P res negative. It's Positive, negative-ish. Do I? Dare I? Nasdaq bear zone bottom. You may like per per mini. There's really no reason I'll choose one over the other unless one of them's obviously more stronger or stronger than the other. They're both pretty much identical today. Nasdaq is probably slightly stronger, but they're going to pivot at the same place. All things being equal. And with the S&P opening in 60%, as time went by, we've talked about this. It used to be 75, 80%. We've made the model more rigorous. And while the Monday, Wednesday, Friday weekly hedge pressure model with the estimations for Tuesday, Thursday, as Tuesday, Thursday option became more of a mainstay in hedging strategies, a more rigorous model was needed for those numbers, and the new rigorous model has tested to be 75% open, close, same side, baby. Would I have doubled down at an MHP? Yes, Chase, I would have 100%. And Chase sees it exactly what I would have done. Because they're only on the S&P 5 points away, I would have got 2. I would have grabbed 3 more and traded from here to there, closed out the 3, held the 2 to run, closed out there. You nailed it. Exactly right, Chase. Dude, you're seeing it exactly. And Chase, why would I add here and then add here again instead of close out? Bonjour, what's up, man? What's up, DD? Why would I choose to long again instead of stop? And you nailed it. Because yeah, the cost base and they're close, right? The distance from here is only 5 points. It's really small. So a rule of thumb is that when the market's like trading down and then pops up very quick to tap a resistance, I always close out. I like to watch markets trade strong with volume to decide if I want to hold on. If you pop to resistance very quickly, I always close out because that happens. That's why I closed out here, because that happens. I don't trust candles, or I close out here. I don't trust candles that move very quick with light volume. Right? You guys are learning. I love it. So by the way, I'm glad you guys are here to watch, to hang out with us. You're learning not to watch your prop firm heroes out there. You guys want to learn actual trading mechanics, feel free to stay here every day. We're new suitor from Switzerland. What's up? Welcome, man. Am I trading tomorrow? I'm trading every day, man. So Shank Singh, hey Matt, what's up, dude? Thanks, bro. Appreciate you, man. So basically, like I said, you guys are being, if you guys are out there watching the YouTubers of the world, they're going to show you like 20 accounts they're trading. And they're going to show you like I made like $300 in each account times 20. What these folks do not do, and I will walk up to their face and tell you they are lying to your face. The one thing they're not showing you is the account number of that account. That might be account, 2,357, because that's how many times they've blown this shit up playing the 20 account game. You might see big numbers of the payouts, but you don't see how much money they funnel back into these accounts. There's nobody out there crushing it with Lamborghini money without popping in 50 grand a month into buying eval accounts. Okay. It's an expensive game, and they're not trading with good risk management. You're not going to go out there and make a fortune trading prop fund accounts by going and getting 20 evals and turning them to funded and then going out there and rolling the dice. You will if you have a lot of money to spend, because that's what I call the blow up strategy, the brute force strategy. Eventually, you'll get a $50,000 payout. It might cost you $50,000 to get to that point. So don't do that. What I'm just saying is don't do that strategy. That is a marketing strategy. Elite Trader Funding has never approached me to market to you guys that way. They've never. So I'm going to tell you straight up, I believe they're honest about it. I've been approached by a prop firm to market that way. I know the numbers because I know everybody in this industry. Your favorite streamers get paid hundreds of thousands of dollars a month in salary on top of the commissions from the sales to do that because it makes you buy 20 of these things. They say, I want you trading 20. I want you showing people 20. I want you showing people tether them together because you're going to blow them all up together. They don't tell you to do that, but they like that way, but that's why they tell you to do that. And they get paid a shit ton of money to show you trading 20 accounts tethered together. I don't teach you that because I think that's stupid. I don't think you have the money to waste to do that strategy. The brute force is only good when they have a 90% off sale. Then yeah, go brute force all day long. I do the same thing when Apex is 90% off. I'll tap off and I'll get 20 past evals. When ETF was 85% off, I passed 20 evals. Same thing. Would I try the entry again? I would technically, but this is just kind of scaring me today. For whatever it is, with the resilience as being negative, DD is strong. It's a good setup from here to here. I should probably take a stab at this. I've already had 2 winning trades, so technically, yes. I should probably try it again. ETF is a 90% off deal right now. Yeah. So basically what you do when you have like really strong deals, and by the way, if you guys are buying ETF, can you guys use our link for them? Because it gives us credit. And we take all that money and we put it right back into the platform. And let me give you our link. If you guys are ever going to use ETF, even if you use their coupon, use our link. They have 90% off right now. Oh, that's dope. So click that link before you check out. You know why? Because it gives us money instead of them. And then we take that money and we build more stuff on the platform with it. Give us a small cut of the sale. Whisper, whisper. So basically, when you guys use our link, think about it like this. Is ETF and I are like best friends. I love these guys. We get like, I don't know whatever percent of the sale, like 12% or 15 or 20. I don't even know what it is. But we take that money and then we pay our developers to keep building stuff in the platform. So essentially, you're getting money back because it circles right back around to you, which is cool. All the proceeds that we make from those ETF sales, we put back in development of the platform. It circles back into the company. So FYI. Most YouTubers and streamers and whatever, that money goes into paying for their Lambo. But let me tell you, okay? Daddy's trading money, bought his own Maserati, and, you know, don't need a paycheck here. We put it back in the platform. So I'm not one guy to be like posting my car all over Twitter to showcase that I make a lot of money. I've always been pretty modest about that. You don't have graphic candles? Oh, whoops. Where'd my candles go? Didn't notice. But yes, so make sure you guys use our link. And then ETF cuts Rocket Scooter a little tiny check. And we'll hire more people with it. I think it's lovely. I actually like their company, and I don't like a lot of prop firm companies. A lot of them have really, like, I can see the math like Fast Track, when it was going, I could see the math of their company's risk model. I mean, I could just see the surface of what they're offering. I'm like, that's not going to work. That won't sustain. Because I understand how much markets can move and how much traders can get burnt, like blow up, and how quickly traders can like make these companies insolvent. I think of all the ones, ETF has the amount of rules that prevent them from becoming insolvent. I think that's kind of where they are now, which I like. The Lambo is slow with the speed limit. Buy a small airplane instead. The guy owes you 20K. The Fast Track guy does? Rocket scooter funding. I don't know if I'd ever want to start a trader funding program. Because I don't know. I like to just be on the other side of the equation. I like to trade them and win them and make the money that way instead of make the money on the side of the casino. I like to play the game rather than host the game. So rocket scooter funding would be fun, but we'd be teamed with I would let someone else do that business. I drive a Volvo now, and iDoc drives the Maserati. She basically, we switched cars. Let me see if I have my. I'll take hedge pressure tap on SPY today for one more trade. For some reason, it doesn't feel like a good trade today. The idea that we are below hedge pressure and it's got pressure pushing down from here, because it's like a 1-to-1 distance between here, I don't feel comfortable trying to long this again because I already did it once. Even though it's probably the correct trade to take after yesterday's move, I still feel like the market's trying to figure out reasons to sell, and Nasdaq's kind of looking a little booty. I'd rather just wait and take the MHP tap. Somebody asked me in a car I drive. Hold on. Stop asking me to sign in. What? Making me sign in to even look at it? They're so. All right. Meta's so mean. Look at this. Security. Gosh, Meta. Why are you crazy? Meta's crazy. Okay. I am a cool car kind of guy, though. I always like having a cool car or a cool computer and cool. That's like that's like let me spend money on that. All right, let's see. And cool suits. I'm a big fan of like dressing nice. So. Oh, if you never seen my computer, by the way. This is my Lambo, you guys, right here. So let me show you where my pride and joy is right here. So this is 2 computers in the same box. I got 2 computers. This is my streaming computer at home. I got 1 computer up here, another computer down here. So this is an ITX mini board. This runs my stream. This is a capture card. I have 2 3080 Ti's that support the 6 monitors, and then basically like all my trading and stuff is run here on the first computer, and then video feed is sent to here, and this crunches the stream and then sends flawless compressed stream encoded to YouTube. So basically, I have a streaming computer and then a gaming trading computer all in the same box on the same cooling loop. So to me, and I built this myself, by the way. So I spent like 3 weeks building this thing. So this is my Lambo, by the way. And I have radiator here, radiator back there. And yeah, custom loops. So I got the pump goes through here. This goes to a distribution plate. Cools that. The distro plate has a parallel loop that cools the graphics cards. So there's loop 1, loop 2. In parallel, and then basically the hot water cools this that doesn't even get that hot because it just crunches a stream and then returns back to here and it goes through 2 radiators to cool it. Yeah, so I built the loop myself, by the way. Thank you. I'm very proud of it. And then of course I made all the cables with the custom color scheme, the black and white scheme. So I did all the cables custom, everything. So yeah. So that's my Lambo, by the way. It's a $20,000 computer. Well, at the time, because I bought all the stuff during COVID. Everything was twice as much. It's probably about a 10K, 12K computer in normal days. There's my car. But I don't use this to sell trading subs, okay? I always drive... I'm not a Lambo guy. I'm not a Ferrari guy. I always drive a 4-door sports car. So before, yeah, let me show you the spec. So like before this, I had a Panamera, which is like the same car in the Porsche size. This is the Maserati version of it. Or Aston Martin is like my other favorite car, but this time around, I was gonna buy the Aston Martin DB11, but I decided instead to go with the Maserati. But why Volvo? IDOC is joking with you. The Volvo is her car. But yeah, so that's my car. I like Italian sports cars, so. The specs, yeah, let me show the specs with you. Now again, this computer was built, I started acquiring the parts in 2020, and then in 2022, this is basically what was in it. I'm gonna take a picture of that. So during COVID, when you couldn't find anything, I was like collecting pieces as time went by. So this, as of 2022, was probably the state of the art at the time. You know, so I had a 12900 unlocked KS for the main computer, a 1090 for the streams for the encoding computer. Don't need a lot to encode, so I bought a cheaper processor there. The main board, 3080s now. The 4000 series is out. So every because I have custom loops, every 2 series of NVIDIA I'll upgrade. Just because you have to go get all new cooling blocks and everything. It's a pain in the ass. So I don't upgrade my video cards at every 2 series. So in the 5000s, I'll get another NVIDIA card. But I had 3080 Ti's, 2 of those, as other I guess traders do on like show cars, what I like to call them. My style of car is like Aston Martin, like DB11. That's like my dream car. I was gonna buy one during COVID. The story with that is I went to go buy one. They had like this beautiful car. It was exactly what I wanted. And COVID was really hard to find good cars. And the guy was like, basically, you know, at the time I was turning, I had a Porsche Panamera and I had an Audi, like A5 Audi or RS5, whatever the highest end Audi was. I can't remember. RS or S, anyways. So like the Audi, the trade-in, they were giving me a trade-in at the Aston Martin dealership. And I was like, okay, let me get a second quote. So I actually drove to CarMax of all places. And they were offering me like $5,000 more for the Audi than Aston Martin. And this was during COVID. So the funny thing was on the spot, they gave me a quote that was better than Aston. And I said, I'll take it. So I drove my Audi to CarMax, sold it. They gave me a check. And then I had 2 like trash bags full of the stuff in my trunk. And I went home. I got an Uber and went home. And again, this is during COVID when you couldn't find any cars and, you know, cars were scarce and all that stuff. Then, you know, I didn't head back up to the Aston Martin dealership for like a week because I got busy at home. I was doing some stuff, streaming, and I was like, you know, okay. So then I got an Uber, went back to the Aston Martin dealership to buy the car I was going to buy. With money in my hands that I got, literally sold my car to CarMax and Ubered home instead of just traded in because I got a better deal. And go up to the Aston Martin dealership and the car I wanted was gone. Absolutely gone. And then everything was on back order. And the ones that were being made, they were only having 8 being made for that year. And they were all coming in 6 months later. And they were all purchased. So I got cock blocked on the car I wanted to get. Which I think is a good idea. Because I ultimately built Rocket Scooter with that money instead. Instead of popping $300,000 on a car, that became part of the budget to build the trading platform at the time. But the universe had different plans for us, I guess. I do love fancy cars. Oh, I'm not even responding in the chat. I need to be reading what you guys are saying. So the Volvo is IDOC's car. And to keep that computer running, by the way, I have to keep the house at freaking sub-zero. It's so cold in there. Brian said, remember me saying, get a pretty girl to get the graphics card from Micro Center. Yeah, so basically the strategy of sniping graphics cards during COVID was to hire a pretty girl to go up and ask the salespeople, like, hey, if a graphics card comes in, could you like let me know? Because they had this lottery system where you couldn't get them when they would come in. Basically, when they come in off the truck, you have to buy a lottery ticket and they draw your name. You can go buy one. The 3080 series were like super hard to get. Spy, I'm just waiting for a hedge pressure tap, and I might stab it one more time with the long, but things are still looking pretty solid there. But yeah, so that story was kind of like, I was gonna buy my dream car with I was kind of sitting on a big pile of cash, and it was COVID, and then I go up to the Aston Martin dealership, and they're like, sorry, that the car that you wanted was gone and there's no more. And I'm like, why the fuck did I wait to go get the car? And then so I didn't have, the funny thing was I didn't have a car for about 2 months because it's COVID. You couldn't find a car anywhere. I went to every dealership out there, and me, I have to have like fully loaded, all the bells and whistles. My Audi was that way, my Porsche was that way, like. And nobody had the car with all the bells and whistles. And so I didn't have a car for a very long time. And I had a bike. So basically, I was just biking everywhere. I was like biking to the grocery store, biking back home during COVID, during quarantine and stuff. And then my fucking bike got stolen. Then I had nothing. I was trapped. I couldn't go anywhere. I couldn't bike. I couldn't car, nothing. Had a fat pile of cash, no bike, no car. I mean, this was in 2020. This is really fun. This is my COVID story. So I found the Maserati by accident because I was looking everywhere for a car. Like I was like, I'll take whatever I can get. And I was looking at like Land Rover, Jaguar. I went everywhere. Like I was like, I'll just take something at this point. I wish I just had my old car back. But that's kind of what happens. Like basically, if you're going to sell your car for cash, go back to the other dealership that day because someone can come steal your car right from under your feet. Dude, QQQ is perfect. You, loser, you're a loser. Whatever, Brian. Wait, hold on. Did I miss it? No, it was good. I took the S&P trade instead. I'm just waiting for it to like, again, this is a good trade to take. I just don't like that resiliences are gross, which is like, well, you mean like wait for this, but so lifetime warranty on that RAM. They will mail you new modules 8 years later. Dan, I didn't know that actually. I know I'm late on reading chat, but on Corsair, yeah, they're really good. I haven't had bad luck with Corsair RAM sticks. That's why I've always stuck with them. The highest end, the Dominator Pro or whatever, titanium, whatever it is, the highest end one is what I have. I think it's titanium. They've always been good. I've never get bad sticks from Corsair. I've been like religious with them. They've always had good quality. Counter volume to go with it. So open and close is always a very strong pivot. And so the halfway point between open and close, as we discovered, we call it the half gap, is always high volume pivot as well, as the market is trying to balance that position that's taken by the market makers at the end of the day. If you notice sell imbalances, an example is at the end of the day, there's something called MOC orders, where if you submit your zeros the close 10 minutes before, if you submit an order to a market maker, they'll fill you at the close price, no matter what the market's doing. So upwards of that deadline, which is why 10 minutes before the market closes, if you guys ever noticed, I've seen some of these gurus call it like power hour or some kind of like algo or whatever. 10 minutes, they don't understand what it is. And I'll tell you what it is. 10 minutes before the market closes, the stock market closes, there's something really interesting that happens. There's a process called MOC or MOO orders. O is open and C is closed, where you can basically tell the market maker, fill me at the open or fill me at the close. And you get basically one price. All right, hold on 1 second. I can get a trade here. Do I want to take SPY? QQQ is, SPY is slightly weaker than NASDAQ, but it is MHP. Oops. S&P resilience is also close to being negative. Let me finish explaining resilience in a second. This is going to be tricky. Let me let it overshoot. I want to tap it. Looks weak to you, Omar. Omar, I actually agree with you. Looks very weak. I'll hit it with, I'm going to literally tap it with one. I agree with you. It does look weak. And this is to just bet that it closes in here somewhere. Okay. All right, so back to redistribution zone. So basically what resilience is doing, let me just put this off to the side to give an eyeball on this one. Trade from here back to here somewhere. I might actually hold this till the end of the day and see what I get out of it. So if you ever notice 10 minutes before the stock market closes, right? Price will be trucking along, and then 10 minutes before the stock market closes, you're going to see that volume starts to pick up and the price will start moving around very quickly. That's because upwards of before 10 minutes before the market closes, an institutional firm has the ability to tell a market maker, hey, I want to dump 100,000 shares of Apple at the close. And then the market maker, if you submit this order to them and you say, I want it to be an MOC order, market maker will go, okay, check. I will fill you at the close for this much at one price. So the open price and the close price is set by the market maker to be the most liquid spot of all of these orders. And the benefit of doing that is that if you're dumping 100,000 shares to the bid, you're going to get each share will be sold at a different price because you're nuking the bid tiers, right? But if you fill an MOC order, you get filled at one price, exactly the close price. So the benefit of it is you just don't have to worry about day trading or the volatility. You're going to just fill at the end of the day at the most liquid price. Hey, I'm rebalancing my ETF or my mutual fund. I'm dumping 100,000 shares today, buying 50 tomorrow, selling 100 the next day, buying 250 next day. You're just rebalancing The rebalancing act gets you one fill. It's easy, it's clean. You're not like day trading this, and you're just basically at the mercy of the most liquid spot. And people are throwing sells, people are throwing buys, and at the end of the day, market maker is matching all these orders at the end of the day. So the reason the opening volume and closing volume is so high is because the majority of institutions are using that. That's why your open price is so big and your close price is so big, because all those orders are being filled simultaneously at exactly that price. Everybody's so good so far about the explanation. That's where your opening volume is massive. It's not a bunch of traders like you and me sitting there with their finger on the button. The market maker is reporting all of those positions. Fill them right at the start of the day. Okay. And at the end of the day. So if the net imbalance or net sum of those trades, what if everybody is wanting to sell, and not many people wanting to buy? At the end of the day, the net sum of all those positions, let's just add it up. There is 20 million set to sell. I'm making up a random number. Actually, let's make it a little bit easier. There's 2 million set to sell. And then there's 2.2 million MOC orders to buy. The net difference between that at close is 200,000 shares outstanding to buy with no seller. Okay. And that's what's called the imbalance. And every day you see NYSE reports a imbalance, right? So when you report an imbalance every single day, this is the imbalance. And the market maker is the one that's taking the other side of that trade. So Apple reports a 100,000 share imbalance to the sell side, buy side. That's actually where that comes from. It's the net residual of the MOC order balance. Okay. So market maker is the one taking a position at the close and at the open every single day. They're taking the imbalance. So the open and close, the reason they're high volume pivots is because the market maker has a position at those levels. And so an example is if the market was trading down at the end of the day, there's a net sell imbalance of 500,000 shares. The market maker is now long 500,000 shares. At the close of the previous day. And say that at the start of the previous day, there's another imbalance of 200,000 to the buy side, and the market maker is short the 200,000 on the other side. And because of that, they gap the price up. Now the market maker has a 500,000 long here and a 200,000 short here. It creates a range for them. They've longed at the bottom, they've shorted at the top. So this range is called the redistribution zone. And this is a principle that we created at Rocket Scooter. It's the net imbalance of anything that the dealer has position on. The dealer is long and short at both of these extremities. So as price is naturally trading throughout the day, the dealers have longed the market here. Dealers are shorted the market there. Anywhere inside of here, the dealers are making money on both of those positions. Right? The dealers want to cover their short and exit their long to always try to be neutral. Anytime the market goes to here, dealers might want to exit some of their long because they're finding other buyers. Market's moving up, there's buyers, and dealers were long. They're going to sell to those buyers. And the market comes down to here, dealer want to cover some of that short for profit. They need to buy from sellers. Well, there's certainly sellers as market's trickling down. So inside the redistribution zone, the dealers are literally redistributing that imbalance so they can go back to zero as much as they can to find other buyers and sellers in the market. So the neat thing about the half gap, and this is what resilience is all about, is that exact process in the index is what's balancing the index's own imbalances every single day. Shares of SPY, buying and selling, etc. Now back to IWM because it's the easiest one to see. You will notice that at the halfway point is like the dealer's balance point in the middle. The middle is always a high volume pivot as you get to it. Here's their high volume. Let me go here. Now this is a little extreme, but there's certainly volume there. There's also volume at the edges. So the principle is that in the middle, if price is moving through here, then your brain should say, aha, it's going to there. Because dealers will only raise price if they're looking for sellers, and they definitely are going to have sellers here. If you're in the middle and you're trading slightly lower, then your brain goes, aha, you're going to fill the gap this way. This is gap filling, by the way. Today's open to previous day's close. This filled the gap. We gapped down and filled the gap. When you lower price, you find buyers. You raise price to find sellers, and this is where they will be. You lower price to find buyers. This is where they'll be. So anytime the index is trading through here, your brain should go, it's probably going to go to there. And to make that decision even stronger, we created a tool called resilience. And what resilience does is it exploits one extra fact, is that while SPY or QQQ is tracking the index, which is equal to the sum of the stocks, right? A function of the stocks. Then it has another mechanic. While it's going to trade within its own zone based on its own supply and demand, it's also kind of locked into the index as well. So if the sum of the stocks are also doing this, if the majority of the stocks are pushing through their redistribution zones this way, then the majority of the stocks are likely, if you're to snap your finger and you add up every single stock, to immediately fill its gap this way or that way based on which side it's on, then you have an implied value of what the actual index should be if the gaps were all filled at the same time. So let me rephrase this in a way that's easy to understand. If I were to draw some boxes like this, and I had all 500 stocks in the S&P, and Apple was here, Goldman Sachs was there, Chevron was there, what our algorithm does is it says, aha, Goldman Sachs is going to move here if I snap my fingers and it fills the gap. Chevron's going to go here, and Apple's going to go here. These moves that haven't happened yet are called the implied moves. So it's why it's supposed to be resilience. It's supposed to be a predictive indicator. If I were to snap my fingers and all stocks in the zone simultaneously filled their gaps, that the actual, which is this line, is the actual value of the SPX. If I were to snap my fingers, SPX has an implied value of what it should be if all of the gapped stocks find their liquidity. So SPY is loosely tracking the actual, but if we calculate the implied relative to the SPY, we get a little bit of arbitrage. The SPY needs to be something different if all the stocks are going to fill their gap because it's tracking the sum of the stocks. So the idea behind resilience is brilliant. It's a gap fill predictor on SPY. Long story short, inside of this box, if SPY is in the middle, the idea was with the SPY is in the middle of the box and resilience is positive, it's predicting that the SPY is going to fill its gap that way because it will likely track the stocks rather than go against them. If you're in the middle of the box and resilience is negative, SPY will go here. It's looking at the implied value. So the implied value of all the stocks, if all 500 stocks are trading up in here, they're likely to fill the gap, then SPY is likely to fill its gap too. And that's the whole principle behind resilience. So it's a tiebreaker in this range right here. If it's long and strong, it'll be greater than 0. If it's weak, it'll be less than 0. So right about here, we lost resilience and it went negative right about here. And all of a sudden, SPY filled its gap this way. How beautiful is that? And it's been negative all day long. So all day long, that's now resistance. It makes that a pivot resistance. If resilience is positive, then this becomes support right here in the middle. Does this make sense, everybody? So it's an arbitrage indicator that's exploiting the MOC principle and MOO principle. And you guys be like, wow, what is all this stuff that this guy's talking about? And in reality, it's just the easiest and cleanest way to describe it. It's a gap fill predictor. If SPY is down here and resilience is positive, then we're going to trade it to there. If SPY is up here and resilience is negative, we're going to trade it to there. Why I didn't chase the long on the bull zone break is because we were wavering. Resilience was not long and strong all day long. It was kind of fighting at zero. So as it finally, the stocks lost their battle, the S&P lost its battle. Isn't that cool? Okay. Does that make sense to you guys? That's what it does. So it's a gap fill predictor of the indices. Now again, the ETF can move on its own, but under ideal conditions, it's a leading indicator. So right about here, you're getting early warning signs, and at the open, you're getting early warning signs. And right here, you're getting early warning signs that the S&P wants to be here. And I'm about to close this trade out because I'm losing monthly hedge pressure, and daddy don't like that. Let me check where DD band is though. Am I gonna assess my red position? Yeah, I'm looking at it right now to see how far it can go. Now again, when you lose resilience, I'm only down 200 bucks. I'm up 1,600 bucks or whatever. I'm gonna wait. I have a stop loss set up. 10 points lower. So 6,010, I'll lose 500 bucks if I'm wrong. I'm gonna hold on to it. Remember, Jimmy, I have a set stop loss. Now, this doesn't look so hot, but I'm going to wait on it. So basically the idea is resilience is a gap fill predictor. So let me show you QQQ today. I use it to decide, it's just an extra layer to like Rocket Scooter's awesome stuff, is that where inside of here does the market want to be? This dashed line in the middle. If res is greater than 0, you'll always see me write this, then it's support. Res less than 0, it's resistance. So in NASDAQ, right about here, the regime has shifted. Right? And the fact that it's negative, what currently was support is now become resistance. And you see all day long, it's resistance. It's having a hard time breaking through it. And resilience is showing me that. So even though we have a bull long up, which is open, blue, open, we have a second layer that says this is resistance. So all day long, I'm trading from here to there, which you saw me make a proxy trade on SPY doing that. And from here to there again. I'm not betting on a breakout because this is horribly negative. So if you add everything up of what we do, there's basically 3 indicators. There's liquidity map, there's resilience, and there's DD. And all of them are pretty strong in what they do. Okay. DD states that 70% of days, because we have a SPY hedge break. Normally it's 90, but under hedge break conditions, about 70% of days. DD greater than half, this is support. And we'll close above here 70% of the time now, about 70% under these conditions. Resilience less than 0. This is resist. Support, resist. It's trading inside of those 2 areas. I'm not long in the farm for a breakout. I've got 1 contract. I'm not betting on a market crash because these are really strong. In 90% of days, we hold this. Because 90% of days we hold this, and this is only 20 points NASDAQ futures away, it's not worth bailing on it because at the end of the day, this is likely to close in here. So I'm good being long where I'm long from. You guys make sense? You don't understand why res would matter for a BZB trade? Right, but it doesn't matter here, but it tells you where your exit target's going to be. Resilience means that this is resistance. So when I always trade to next resistance, there it is. If resilience was positive, then there's no resistance until DD ban. So remember, the liquidity map always trades to next resistance. This is a variable spot that can flip-flop support, resistance based on this. Because it's now a resistance, it's the exit of my trade. Does that make sense? Cedric, I've actually never opened the resilience settings except for the very first time I changed the color. Half gap resilience. So there's two different resilience modes, and they're designed to be tiebreakers by explaining the arbitrage of what stocks are doing. So while you have like this basically a tiebreaker here, let me make that bigger. Let me use IWM, it's easier to see. Like basically you have two different modes, right? If the S&P is, or NASDAQ or Russell or whatever, and again, resilience only is for a basket of things, right? So it can predict this, or try to predict that if this is tracking the stocks inside of here. So if Russell is sitting in the middle, the half gap, then half gap resilience helps you decide which way it's going to flow inside of this box or against this box. With the Russell resilience being negative, we know that the half gap is resistance. As of all morning, it is resistance and not longing from there, right? So the orange one is the same principle at monthly hedge pressure. We do a very similar thing with the net gamma flow of the stocks. If monthly hedge pressure resilience is positive, it means the majority of stocks are gamma positive on their monthly options rather than negative. So if like the index is hitting its monthly hedge pressure, and normally we would long that 90% of the time and close on the same side, this is an indicator of how strong I'm going to long that. If the indicator, the orange one, is negative, this is likely to break and keep falling. I might not long it or long it much smaller. Like if this is strong like it is now, then MHP is a strong contender for a long. Therefore, by proxy, I know I'm trading the S&P. Sorry, oops, come on. So I'm willing to take the S&P long because the stocks themselves are holding the MHP. So basically, I'm looking at the idea that I can kind of guess what the S&P is going to do based on what the stocks are doing. And as you see right here, the net sum of the stocks market cap is gamma positive left on its own. So for S&P to break MHP and keep collapsing may not be what happens if the stocks themselves are going this way. So this is giving me extra confluence that the stocks are bouncing and going this way. Another reason why I'm not bailing on the trade. I'm not adding to it because MHP break, right? And the market is selling a little bit, but I'm certainly making the bet because the stocks themselves are nice and healthy. And if I lose 10 points, I lose 10 points, so I'm going to bet it small. Let's set up auto trader. Let's go. But didn't you say that you didn't take the bull zone bottom trade at the beginning of the session because resilience was negative? The bull zone bottom or the bear zone top? Which one? Never about SPY? I did take this one. The bull zone. Okay, yeah, the bull zone bottom. Yeah, correct. This one right here. Because if you look at the cheat sheet, let me show you the cheat sheet. It'll make all the sense in the world. Yes, you are correct. Let me show you what I mean by that. This is where you be clever with resilience. Let me show you. Go to your cheat sheets. You're going to love this one, man. Look. Look at this. When resilience is negative and you're trading above the box, it's a ticking time bomb. It wants to jolt down here and close the gap. Okay? And because resilience was negative, up here, it wants to close the gap. Even though you're outside of the box, if you're trading above the box and res is negative, get out of the way. If you're trading below the box and you're shorting and res is positive, get out of the way. It's going to try to fill the gap. Does this make sense? Cedric, great question. This is where resilience can clue you into your trade being a bull zone trap. As we went through here and resilience was negative, Cedric, we good? Res is negative as the markets move into this side of the box and resilience was negative. So it's trying to make its way back down and it was fighting at 0 and it wasn't long and strong. That's why I didn't take the long from here, because at exactly this point in time, resilience was just barely peaking above. It was at 6 and 9. It wasn't that high and it wasn't getting a lot of strength. And so I was waiting to see if it was going to pick up a lot of strength. And as resilience started to deteriorate further inside of here, as the cheat sheet shows, it tends to fill the gap this way. And so I didn't do it. Okay, yeah, cool. Okay. So it's actually very useful outside of the box, only if it's counter to the trend. Like up here, I don't care how positive resilience is. It's not making any choice of mine. But if res goes negative, my brain immediately says, get out of the way of the long. Just like the market's down here. And if res is positive, I say, get out of the way of the short. It tends to want to complete the move, the tracking move more often than it doesn't. So that's where it was helpful. And I don't like that this is moving against me. As we see, this is trying to test 0 and it's still positive. So I still have faith in this. That's why I just have a small position. But yeah, so this day right here, normally bull zone breaks. I left to take a long small to DD, but I didn't because this wasn't really strong and positive. It wasn't giving me a lot of love here. And as it was dipping through here, it just tried to make its way back to there. And you can see that it kind of lost a little bit of steam today. So it prevents me from chasing along because the stocks themselves aren't getting a lot of love up here. The stocks actually are trading below their half gap. The majority of the market cap is trading below its gap, below its zone. MHP is looking to be resistance now, correct, but this is looking to be strong, so I still have faith in this closing up here, but we'll see. I got one contract. It'll put $500 in my pocket if I'm right. We'll just wait on it. Shorting SPY off MHP break would have more sense if MRES was negative only. It is, but see, shorting MHP break is always a setup. Right here, this was a good short entry for the market to collapse out if you're willing to trade this. That's why I'm only longing with something small. The correct trade right now is to be short from right here. And again, without this agreeing with it, you might lose that short. But then again, it might play out. So the correct trade today, always MHP short chase. Like we lost here, there. I don't like to flip-flop my trade. Because this is positive, I am taking the long bet. But if you are taking the short bet from here to DD is a really nice run on a small setup. And yeah, because it disagrees with you. We always tell you, like, don't trim a short setup to trade it slightly smaller. In this particular instance, you can use this as confluence on a short. But the MHP break may not care what this is saying. This is just helping me decide the size of my position on the long. And like I said, I'm not in a good spot right here. Yeah, MHP break has a pretty good R&R on this one if it does fall. Kind of where I was like, oh, it's getting close to 0. Now the stocks are starting to hold, which is good. But see right here, if it broke and this was below 0, I probably would have got out there really quick to wait for it to come here to short it. If this orange line was really bad. So I wouldn't even wait 10 points. But because it looks good enough, I'm still going to wait 10 points to see if it goes. And then that we bet that we close up here. But like I said, I'm only in one contract. Yeah, you nailed it. I use resilience a lot of times to throttle my position size because resilience and DD are my confluence indicators. So the better the confluence, the heavier the position. I only bought one contract here because this was flirting with 0. Okay, so when we got there, this was right on the edge. That's why I just barely one-tapped it. See that? So I'm using the confluence to change my position size. And that's why we teach you with resilience and DD. These numbers are great for position size confluence. Yeah. Cool. Omar, I agree with you, bud. Doesn't look to be sell-off day either. Yeah, I mean, I'm taking that bet, but I could be wrong, so we'll see. Dang, you hope you win that lifetime membership. You need that long to master this. Let's go, baby. To says, look at the volume everywhere and QQ hitting MHP, dude. It's just like clockwork, and I love it. It's crazy how often you get quick 10-point bounces off a hedge pressure. I'm not gonna lie. I mean, I make a living doing that. I don't need the market to run 100 points for me to put $1,000 in my pocket every day. These little tiny 10-point scalps here and there, that's money in your pocket. So, all right, I'm gonna be right back. I'm gonna go get me I'm gonna get downstairs and get me some coffee. This hotel here. Y'all hang tight. All right, y'all, we're back. Back in. Oh, look what I missed. Oh, this ain't looking hot. This ain't looking too hot today. I'm gonna close out. Let me just let. This is just looking pretty gross. I'm gonna close out. I'm gonna call that So 200 bucks down on that one. I'm just closing it. So I'm gonna wait till it reclaims and get back on the long side. No more trades. I'm done. You were in the bathroom. I know. I was downstairs. So again, the short setup looking solid, and any fall today, like I said, I got out of the way of that one pretty quick. Any fall today goes down to DD band. So look, let's let this market do whatever. I've got two setups today. MHP break. I'm back on the long side. I'm longing from here to bear zone top on the bounce. A lot of supports on QQQ as well. Overnight MHP dynamic is pretty good. QQQ has hedge pressure here. Also, for whatever it's worth, I'm feeling that this market, especially with SPY losing MHP, SPY yanks the Nasdaq around. If SPY is losing its trade for the day, don't trust the Nasdaq. This is rule number 2 here. The rule number 1 is trust all things Rockstreet. Rule number 2 is SPY is the granddaddy of all things. If SPY is bad, Nasdaq is bad. SPY has like a chain. This is supposed to be a chain. These are links in a chain, I promise. SPY is tethered to the Nasdaq. It's like that game where two people are tethered together. We all played that video game. It's hilarious. If SPY moves down, it yanks the Nasdaq with it. If SPY moves up, it yanks the Nasdaq with it. If Nasdaq decides to do anything on its own, SPY don't care. It's a one-way chain. So if the S&P is breaking MHP, I'm not longing Nasdaq thinking, okay, Nasdaq's going to bounce. SPY is the granddaddy of all analysis. S&P is. It's more diversified. If people are fleeing all of the sectors together, it's hard to believe that healthcare, telecom, and tech will save the market. Trust the diversified index more than you trust the smaller index. So one can always take a pivot trade. Yes, you can always take a trade here. But as we teach everyone, again, you can always take the trade on Nasdaq if SPY is looking bad. But because SPY is looking bad, you're losing confluence on the long. And what is the rule here before we close down the stream today? What is the rule on longing? If you lose confluence, what do? And it's not a two-way street. You don't say, Nasdaq looks bad, the SPY is going to collapse. Pretend that the S&P is its own thing that don't care about anything else. You don't, not stay out. It's confluence. So when you lose confluence, you can trade smaller. So if I normally was going to long Nasdaq from here to here with like 3 contracts, and all of a sudden SPY is one extra layer, is losing its MHP, I might just want to trade it smaller because the probability of the SPY yanking it down is higher. Yeah, so everybody said step down. Always be confident to take longs as much as you see them. You could take this long all day long. As a matter of fact, I probably should have been trading QQQ. That was an easier trade. But because SPY is looking a little booty, I might just tap it smaller. Right? Get in, get out, get in, get out with like 1 contract instead of whatever I was normally going to do. So remember, the best part about longing the market is that you get so many layers of confluence to trade smaller if your confidence isn't there. And because SPY has clearly broken MHP, Nasdaq, while trying to long, is ultimately being yanked down by all the stocks threatening selling off, right? So I will say, okay, Nasdaq is not likely going to bounce here and rally, and it has a higher probability of failing because the SPY is failing, but it's also a decent probability of holding because its own stocks are holding. So while its SPY is trying to yank everything down, Nasdaq's own desires are floating it back up. So because you have that push and pull relationship, SPY is yanking everything down that way. Nasdaq is pulling everything up that way. You know it's probably going to chop really hard, and ultimately S&P will likely win this fight, but that doesn't mean there's not some good long scalps in the way. I'm not shorting NASDAQ because S&P is falling. Let's get this right. Remember, I don't chase a short on anything unless its own thing tells me to short. NASDAQ is a perfect short right here to take on the chase if it does lose, because SPY is already there. But because, while this looks good for up, SPY looks bad for down, I'm losing confluence on the long side. I'll just trade smaller, as Scott and Gabriel and some of these others are saying, and Rich is saying, set smaller targets. Exactly right. So anytime you lose confluence on a long trade, just smaller positions, smaller targets. Take your quick scalp, get in, get out. Don't bet for the reversals, you know, things like that. And so it's not a terrible idea to take longs in NASDAQ here. But it's certainly a terrible idea to take longs from NASDAQ here to bet on a breakout. Long next resistance, long next resistance. Probabilities are high that this ends up here, but we have clear, as I've been yelling for the last, hour or two, S&P is giving us clear signs that today's a dangerous day, right? So I'm not chasing green candles, betting on a big breakout. SPY MHP is giving us some pretty nasty signs, right? And again, MHP breaks are, we teach this in our class. Get out of the way long. If you lose your confidence, get out. And I was downstairs when this happened, and I'm out. And I'm not even trying to buy down here, nothing. I will long again if we are here. I am back, and I will jump in on the long every single time. But no, this is an investment advice. But if I wasn't in a trade, like I'm not in a trade right now, I will not long anywhere in here except for lower DD band. That's it. So no buying, no bag holding. Again, no investment advice. If I were in a long position right now, upside down any amount of money, I would be happy that it's that instead of blowing my fucking account. I would close every long I had right now if I were in any trade like I did. This happened and this happened. This is always a Marriott for the points. And I go for the, like I said, the free breakfast, so I can walk down, get my breakfast, come up and stream. Free breakfast, free coffee, free parking, free Wi-Fi, $100. That's all my work trips. Oh yeah. Spring Hill Suites. Damn, Neil guessed it. Jesus Christ, that's it. Spring Hill, baby. That's the way to go. I wasn't gonna tell you, but yeah, dude, it's the best. What's the best for its value? You stay there? Yeah, and you get you don't get much better than that when it comes to like the value of whatever you're doing. You're not looking for like a resort with a steakhouse in it. You want your Texas shaped waffle and your eggs and your bacon, your croissant, your yogurt cereal. Yep. And you get your Marriott points, so. And each room comes with a desk. So that's also why I ultimately picked it. It's got like a little cubby hole desk, which is really nice. Bro, you never had a Texas shaped waffle? Like every time you travel to Texas, look. Every time you travel to Texas and you stay in like a hotel with a continental breakfast, it's a thing. They all have a waffle machine that like, you have like the little thing with the handle and it's got like a little spout, and then you get your cup and you fill it up with the waffle batter, and then you dump it into the waffle machine and you spit out Texas shaped waffles. This is every hotel in Texas. Every hotel in Texas has a breakfast will likely have a Texas shaped waffle machine. It is a thing. I don't eat waffles because of the sugar and all that stuff. I usually just eat protein. But yeah, you pour it in the cup, you dump it in the machine, You cook your own waffle. It's kind of fun. When I was a kid, we used to do it all the time. Every hotel we'd ever stay at when we were kids, because we used to, my brother and I played Little League, and my brother was in the World Series, so we would like travel around the country to play Little League. That was like our only traveling as kids in baseball. And so we would go hotel to hotel, and you'd always would, as kids, we were super excited to get our little Texas shaped waffle. It tastes better when it's the Lone Star State, I promise. But honestly, for the value, yeah, you can get much better than Spring Hill. For my non-pleasure trip hotel experience, it's great. The one thing I hate about them though is they don't have upgraded internet sometimes. I get really kind of. This has not actually been that bad of a experience though. The stream has been good. But last, like when iDoc Talk and I went to New Orleans, you know, it's like $500-600 a night plus parking. You know, we stay at the Ritz-Carlton, and you know, and then you got to go eat lunch somewhere. You're talking like $700, $800 a day just to stay. But you know, you want to stay somewhere nice. We'll go to the Davenport and listen to music. We're there for fun. But when you're there for pleasure, okay, spring. But when you're out for business, all you need is a bed, internet, free breakfast, free parking. Can't beat it. Shout out Super 8. It sucks. I've never stayed at Super 8. To me, there's always a time to waste money, and it's when you're having fun. If I'm hanging out with you guys on the stream, I don't use internet. We're good. Don't stay at Super 8. But yeah, I recommend Spring Hill all day long, or Town Place Suites. Those are both pretty good. I think Town Place is Hilton though. No, it is by Marriott. It is Marriott as well. Town Place and Spring Hill. Yeah, they're all actually pretty decent because they come with desks, which I really like. And there we go, baby. I'm out of the way. I got out of the way. We had a head start by like 20 minutes to get out of the way, and it's falling. Wait, Comfort Inn has the best breakfast? That's what I'm all about. Spring Hill's pretty average. It's like you get cereal, yogurt, bagels, croissant, Texas waffles, eggs, bacon, sausage, coffee, yogurt, all kind of cereals. It's all free. And the eggs are like sometimes halfway cooked. The bacon's always like soggy, and but it's breakfast. The coffee's not bad either. Why I didn't take the MHP long? Chase, I did. I longed, and I little booty. S&P, look, see how the S&P is starting to like fall a little bit. 148 is Dan is forecasting a DD band tap and overshoot. I wouldn't disagree. If this does flush today,